Analysts have started to raise their price target on Google. In fact, some of them are going as high as $300, and we are fully now into earnings season, with Google themselves reporting on the 29th of October. So literally next week we will find out how strong or how poor their results will be. But one thing is for certain, this company has been on fire in 2025. Hasn't always looked that way, but when we do look at a year-to-date performance, many companies in the green, Google is no different, where they're up 34% year-to-date. Now, we will highlight that they are facing some issues in the shorter term, and that is in the name of OpenAI, where it's also making some retailers nervous as well, where typically there would be a lot of web traffic going on your favorite retailer looking for products to buy or sell. It looks like ChatGPT has implemented a feature where you can search a product as well as instant checkout, which could be a little bit bearish for Google if we do start to see some of that search get taken away, and we're going to cover that a little bit later. The main thing that we need to point out is that OpenAI just yesterday launched their own web browser, in fact calling it Atlas, and it was quite interesting to see the effect it had on Google shares. It did send them lower, but actually it recovered pretty strongly after, went as low as 246, now as we'll come to show you, trading very near to its all-time highs. And even more fascinating is that this OpenAI new web browser is on the Google infrastructure. It's also quite interesting to note that as the market does look to be very red today, even with some of that potential bearish news from OpenAI, Google is one of the few that is in fact up. We're seeing 1.5%. Netflix, one of the worst performing today, they're down 9%. And if you wanted to see the reasons why and our own valuation, well, we did drop an episode earlier today. So we're going to have a quick look at Google before their earnings next week, run it through our own valuation as well to come to the understanding, is this one that will go to $300 anytime soon? Now look, over the last year is up 54%. As we said, year to date, strong, up 34%. Over the last 10, nice outperformance of the S&P, as we will come to show you. And you can also note here, very close to their all-time highs. Maybe we'll see it smash through that after the earnings. And Wall Street still maintaining this at a buy, 4.47, very, very close to the 4.5 to flip it into a strong buy. Seeking Alpha giving it a 4 out of 5. And if we kick things off with the valuation, on a forward P, it sits at 25.6. Now that is above their historical 21.6. So in isolation, we would say potentially overvalued. And that's something that's also confirmed when we look at the blue tunnel. Now remember, parameters within the blue tunnel highlight the intrinsic or fair value, and we're seeing for the first time in 2025 sitting above at the upper end. It was trading quite some time from March this year all the way to July, August in an undervalued signal. Now we see this trading at the opposite end, where in fact over the last 5 years, this one for quite some time was trading at a large discount overall. It looks to be one that does in fact do this quite consistently. So if you are patient, you want to add this, it is likely we will see this once again at some point in the future come back down to an undervalued level. And if we look at the valuation score of an F, well, that is because they're trading at a 79% premium to the sector. They're also trading a premium to their 5-year, which we just highlighted. But if you really want to look at how does the growth get baked into the valuation, well, on a PG basis, 1.7. Now look, yes, below 2, we love to see that, gets us excited, makes us want to dive a little bit deeper. It is above the sector at 8, but more importantly, against their own 5-year average, it is at a 23% premium. So historically, Google doesn't trade that high on a PG basis, 1.35, now it sits at 1.66. Doesn't mean you should buy or not buy solely based on one valuation metric, but always good to look against historical comparisons. And just remember, with their earnings that is coming, in the previous one, revenue was up double digit 14%, analysts will want to see that search advertising is still strong. It was up 12% in Q2, and maybe more importantly, what is the Google Cloud going to show when they report? Are we going to see the continued strength? It was up 32%. That was very impressive. We'll touch upon that shortly as well. But also, will we get efficiencies again? We saw a 1 percentage point increase in their gross profit and their bottom line, something we always love to see. It is also a company where search makes up the vast majority of their income overall, and dating back to 2020, it has continued to climb at a double-digit rate, 16.9. We just pointed out previous quarter, 12%. Question number one, will we get to see the continuation of double-digit growth? And another equally important question is, how will the cloud revenue be? In the previous quarter, they were 32% growth. Love to see that. Behind Microsoft, that really did impress investors, up 39. And whilst AWS may be the market leader in number one, the growth was substantially lower at 17. So question number two is, what will the cloud growth show us? Will it be strength, or will it in fact be weakness? And the projections are a slight drop from 32% into Q3 at 29. Still very strong, but behind Microsoft, that is estimated to see growth at 37%. You can also note, in terms of revenue, Google is number 3. That is expected to continue, and by quite some distance as well. AWS does sit in number 1 place. With another question, analysts will be wanting to see how much are they estimated to spend and how much have they spent on CapEx, where even though they had a fairly strong previous earnings Q2, analysts were very surprised, maybe a bit disappointed as well, about the increase in the CapEx spending, where they estimated for the full year it would be 85 billion, where initially they had this at 75. So we could actually see this go in fact higher. That is what some analysts are estimating, above the 90 billion region. But again, question number 3, what is the CapEx spending going to look like? When we look at the data, it does look to be strong for Google overall. In fact, what we're seeing here is the month-on-month growth rate of leading generative AI websites. Gemini sitting there very strong, up 46% from the previous month. That is significantly higher than ChatGPT, which was up only 1%. In second place, we have Perplexity. So this could be a good sign that when they do come to report their search, we may see some strength that perhaps analysts aren't expecting. And we can note in the previous analysis, August versus July, 3.4%, still above ChatGPT, perhaps signaling ChatGPT isn't the killer that some analysts thought it would be to Google overall, and that is why we've also seen a lot of strength in their share price in the recent period, with visits worldwide also exploding for Gemini. If we look now, it's sitting over 1 billion. That is in September 2025. That is a very large increase and quite rapid. In fact, noted from the beginning of 2025, Gemini has started to be something that many people use, more so than ChatGPT. This is a very positive sign heading into their earnings. And if we look over the last year, yes, OpenAI has had the largest portion of traffic share. We're talking around the 80 to 90% region, but in fact, over the last year, not only has this decreased, but look what has started to steal away at that traffic share. It is Gemini from 12 months ago. Now it's been getting larger and larger, all pointing to good things expected for Google's upcoming earnings. And just look at the total visits to Gemini. September last year, 275 million. This September, just under 1.1 billion, an increase of just under 300%. And just more positives in terms of the paid click growth, it continues to increase 4% in the latest quarter, whilst also still seeing in number 1 place in streaming being YouTube. 2 years ago it was at 9%, and at that point it was also the market leader. Now it's sitting at 12.6%. Granted, it was a dip from the previous month, but that was also seen across second place Netflix. They're still holding that number 1 position, which only strengthens Google's overall business. And more positive news that Waymo looks to be in a very strong position. They're planning to launch this service in London next year. It does look like lots of positives and good strong catalysts for Google moving forwards. And this is a company that also has outperformed in their last 4 quarters, a 100% track record. Over the next 4, now they are expecting 3 or 4 of them to be growth, with ultimately earnings per share to come in just below $11 for the next full year, in turn dropping the forward P, although marginally, to 23.5. And if we just look at their earnings estimate, well, over the last 2 years, in terms of 8 quarters, They've outperformed 6 of them, EPS missed 2. They've outperformed 5 of the revenue and missed 3. So a little bit inconsistent, a little bit more difficult to see how this upcoming quarter will be. But if we look at the earnings per share, they missed December 2022, and we were talking about a 3.6% miss if we go back to the one before that, December 2017. Same thing when we take a look at their revenue. We can note December 2024, it was a miss, very trivial though, $39 million. And again in 2022, we are talking about some trivial misses. So based on historical data, not the greatest thing to look at, it does seem that we'll get a very strong performance from Google, and if they miss, which is unlikely, it will only be a very trivial amount. A fascinating thing to point out though is that institutions with their 40% ownership who sold 58 billion worth of shares in the last year, they bought a lot more at 123 billion, around double, in fact slightly above. But in the most recent quarter, very interesting, they actually sold a little bit more than they did buy. If we want to go back to another quarter where they sold more than they did buy by quite some distance, you'd have to go to Q2 2023. Now, it doesn't mean much, but we always like to see what are the institutions doing the first quarter in quite some time where they were selling a bit more than they were buying. And with a growth grade of B, last year they grew their top line 13%, estimated there or thereabouts over the next 12 months, which is above the sector, but worth highlighting that Google's revenue growth has been slowing down over the last 5 years, and this is also expected to continue in the earnings per share, projected over the next 3 to 5 years, 15%. Yes, above the sector, but actually slower, like we saw with their revenue, than their 5-year average of 18%. In terms of the profitability, we do notice though an A+, gross margin 59%, above the sector at 54%, also an improvement to their 5-year of 56%, so great to see efficiencies, and bottom line 31%, well above the sector at 4%, above their 5-year of 26%, so great to see. Yes, they're slowing down in terms of the growth on the revenue and the EPS, but they're improving their efficiencies, margins are getting larger and larger, always a great sign. In fact, that is a sign of a high quality company, whilst also generating a lot more cash from operations, 134 billion in the last year, well above their 5-year of 97 billion. And probably also music to investors' ears to hear that now over the last year, Google has massively outperformed both S&P as well as the QQQ, 53% versus 15 and 24, something that also holds true and by quite some distance over the last 5. They're up 218 above the S&P 96, above the QQQ at 121, and again holding true when we zoom out further over the last 10 years, up 584%, significantly outperforming both of these. Question is, can they continue to do it over the next 10 years, as ultimately past performance is not an indication of the future. And if you wanted to look under the hood at some of their underlying metrics, well, free cash flow per share, we want to see consistent growth over the long term, which is pretty much what we get over the last 10 years and expected to continue into the next 12 months. When we look at their sales growth, well, out of the last 10 years, they've grown their top line, 9 of them in fact, 2023, the odd one out at 9%, trailing 12 month looking decent at 13%, and one thing they're also doing is buying back shares, returning excess cash to investor pockets. It's gone from 13.9 billion in 2015, now at 12.3, something they've actually started to ramp up quite significantly in the last few years. If you want to see one of our favorite metrics, well, ROIC, where we want a minimum of 10%, give us faith, Mandarin are able to effectively allocate their capital. Incredibly important for this company with very high capex spending, going from 12% 10 years ago to now sitting at 24%. Margins also very important. We want to see them increase. They're also well above the minimum, going from 26 10 years ago to now at 33%, and free cash flow margin looking very strong, although a slight dip on a trailing 12 month at 18%. Finally, probably one of our favorite metrics, the net debt to EBITDA. Below 3 is what we want to see. 0 across the board. Now, these highlight the number of years it would take Google to pay off all of their debt net of cash on hand, telling us, and remember, correlates to balance sheet strength, it won't even take them one day to pay it all off. That is a very, very strong balance sheet, something we really do like about this company. It's also important to understand that yes, revenue has been growing over the last 10 years from 75 billion now sitting at 350, but very interestingly, not all companies are able to keep that consistency with their bottom line net income, but Google is one of those that we also notice a very similar growth pattern from revenue to their net income, going from 16 billion 10 years ago to now sitting at 100 billion. That is absolutely incredible to see. Just look on a trailing 12-month, 115 billion. Very strong signs that Google is moving in the right direction. With the other thing to note, a quick health check, total cash versus total debt, going from 72 billion 10 years ago, now sitting at 95 billion. Yes, it's great, but as always, one number here will give nothing away. So we compare it to their total debt numerically and directionally, and we can see that has in fact been increasing quite significantly over the period. 8 billion 10 years ago to now at 42 billion, but as we just saw, the cash is far superior, and as the net debt to EBITDA pointed out, it won't take Google one day to pay off all of their debt net of cash on hand. Very strong balance sheet indeed. Now, before we get into our valuation, just to let you know, we have released our latest free weekly article. We draw on every single Sunday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside as well that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, our intrinsic price coming to $229 a day, derived from the discounted cash flow model. We've used a growth rate of 20%, but in reality, a very important thing here is what does the reverse DCF highlight? It says 13.6%. Now, what this tells us, if you are buying today at the market value, baked in is 13.6% growth to the future free cash flows over the longer term, which may already tell you if this company is over undervalued. If you believe it should be higher, 14, 15, 16%, then potentially undervalued. If you believe, no, this is way too high, then overvaluation. Now, we've gone for 12%, but you can see other rates being used here. As always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Google or any others. But with the growth rate and the discount rate, it gives us the present value of future free cash flows. Add together with the cash, subtract total debt, divide by the shares outstanding, we get to the intrinsic value, indicating downside of 11%. Now, you may even look at that and say 12% is way too high. Well, look, at 10% growth rate, it comes to just below $200, which indicates downside of 22%. You may be in the other camp and believe that no, we're being too low. Well, at 14%, $263, 3% upside. Or in fact, you may think, again, this is something that should be a lot higher. At 16%, where we put here extreme because it is above the higher rate, $302, indicating 18% upside. And why we've used this, very important, as we saw at the beginning, some analysts believe this company is intrinsically worth $300, which means they estimate around 16% growth to the future free cash flow moving forwards. Now, what we typically like to do is use the middle rate because we're not done there. We like to apply a margin of safety, 10%, execute if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, which would mean a buy at $206. What this is actually reflecting is that today there is no margin of safety. If you believe 12% growth rate to be appropriate, you're actually paying a 12% premium. If you want to make a note of the rates, well, at 10%, a buy at $206, at 20, a buy at $183, and at 25, a buy at $172. The other thing to point out, for those that actually believe we're being too conservative, at 14%, which is the higher rate, you are getting a margin of safety, but very trivial at 3%. Again, if you wanted the price targets, at 10%, a buy at 237, at 20, at 210, and 25, 197. As always, let us know your views. Is it right now a buy, hold, or complete avoid? And Wall Street, even with their near strong buy rating, they see $260 into next year. That is only 2% upside, and that is an average price target. For those that believe $300 price target is appropriate, want to see it at that 16% growth rate moving forwards, well, that in turn does give you a 15% margin of safety. Let us know your views on Google. Is it a buy, in fact, before the earnings, maybe a hold, or a complete avoid? And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.